Welcome to Behind the Ticker, the podcast where we go beyond the symbol and into the strategy. I'm Brad Roth, founder and chief investment officer at Thor Funds, and in each episode, I sit down with ETF managers, CIOs, and industry leaders to break down how these funds are actually built, how they behave in real markets, and how advisors use them in real portfolios. Most people just see a ticker symbol, but we know much more goes on behind the ticker. Hey, Bob, welcome back to the show.
Hey, thanks so much for having me.
So we've sat down, I think, one time in the past, maybe twice, but why don't you take just a little bit of time to refresh everybody, a bit about your background. I know you spent a long time at Bridgewater and now you're running Unlimited. So how did that journey kind of all happen and take place?
Yeah, I mean, as you mentioned, I spent the majority of my career at Bridgewater, where I developed proprietary investment strategies across a wide range of different asset classes. And over my time there, I sort of increasingly recognized there were two things that kind of everyone in the industry recognized, but no one would really say out loud. The first is that once you become an institutional quality hedge fund, you're largely no better than your peers over time. Of course, any one year you might do better or worse, but over time you're all largely, together generating a fair amount of alpha, but not really. No one manager is so much better than the other. The second thing that certainly no one would say out loud is that we were getting paid way too much. And what I mean by that is that across the hedge fund industry, the vast majority of the alpha that was generated by hedge funds was being taken by the manager in fees, leaving investors not that much better off than they would be on their own. And so if you think about those two key points, the solution to become a great manager or develop great hedge fund strategies is not to try and be smarter than everybody else, because that's a Sisyphean task. The key strategy to do well, to be the best hedge fund manager you can, is to diversify across managers, to reduce idiosyncrasy and reduce fees. And that's what Unlimited is all about, is basically taking that core set of concepts, diversified low-cost indexing, which has totally changed stock and bond investing, and bringing it to the world of hedge funds. Now, of course, doing that, you can't just invest in the funds because they want to get paid, and then you have to pay yourself something, and then you've got fees on top of fees. And so instead, what we've done is we've developed technology that looks over the shoulder of how managers are positioned in real time across each one of the major hedge fund styles. And then we take that understanding, translate into long and short positions and liquid securities. And from there, we use that understanding to build our hedge fund ETFs. And so been in the market for a few years. HFND, which is really just, you can think about it like SPY for hedge funds, matching hedge fund industry volatility, which is like bond risk, has been in the market for a little over 3 years and has demonstrated a track record of tracking hedge fund industry returns. And then this year, we launched a couple of individual hedge fund strategies, HFGM, HFEQ, and HFMF, which are global macro managed futures and equity long short strategies, but done at a 2x target return, one that matches something closer to equity index volatility, and something that a lot of advisors find interesting because it's more cash efficient and you get more bang for the buck of the low fees you're paying.
Yeah, and I definitely want to talk about your two new funds in detail today. But if I'm a skeptic listening to this and saying, okay, hedge funds are charging 2 and 20, they're expensive. How can hedge fund returns be replicated using, ETFs and futures at sub 100 basis points, right? Like, how does that process work? And what would you say to that skeptic to say there's no way you can do as well as we do at these types of price levels, I guess?
Yeah, well, I think it all comes down to building technology designed by people who actually have run hedge fund strategies. Between my co-founder and I, we have 50 years of having built hedge fund strategies and made billions of dollars for clients using those hedge fund strategies. So we have a really good understanding of how managers think and how they construct their portfolios. And one of the key insights that we had in terms of developing our technology is that managers cannot flip positions instantaneously. And that's really important because what it means is if you're managing any reasonable amount of money, you can't be long stocks in one day and short stocks the next. And so because of that, positioning is path dependent. And what that means is that when you see an outcome in a given day, we have some daily information, some monthly, some weekly information. that performance, the set of positions that are driving that performance, they have to be a set of positions that are close to what set of positions drove the performance the day before, and the day before that, and the day before that. If you think about that, what it means is that there's not that many portfolios of plausible exposures that managers might have on that are adjacent to each other that describe all of these returns. And it's one of the ways that we can actually, one of the nice things about this way of thinking about it is we can actually pick up a lot more of the tactical alpha because we don't use sort of like a long-term rolling regression where we're sort of averaging months or years worth of data. We're solving for today's portfolio in the context of those previous portfolios. And look, the 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 theory and the technology, I could describe conceptually to people, but there's also looking at it on the field. And when we look at how well at how those replications have done over the course of the last 3+ years since we've been in real time, they're delivering on showing that we can actually track how hedge fund managers are positioned.
So I guess if we take a step back, though, for a second, why should advisors care about hedge funds or hedge fund exposures? Like, why are they so important? And you and I have talked before. You and I have the same, belief system here around alts and their need. Can you just maybe back up for a second and talk about the importance of having these types of strategies in overall portfolio construction, just in general? And you're taking it, I think, a little bit one step further, where and I'm not saying this to apply cheapness, is really are the vanguard of the hedge fund space. And so you would be, in my opinion, somebody who wants to get alt exposure and do it rather efficiently, cheaply, and easily would be the spot to look. So why should people be looking at hedge funds or alts just in general?
Well, it seems as though you know exactly what our first slide is of our company pitch deck, which is exactly right, Vanguard for the 2 and 20 side of your portfolio. The reason why hedge fund strategies are so valuable in a client portfolio is the vast majority of investors are their portfolios are long only, and they might be long only in public asset classes like stocks and bonds. They might be long only in alternative assets like private equity or venture capital or private credit. But all of those are long only strategies. And by definition, they are all influenced by the same basic concept, which is asset prices have to go up in order to make money in one form or another. And one of the nice things about alternative asset, and the way I describe it is alternative strategies, not alternative assets, but alternative strategies, is like hedge fund strategies, is they have the ability to go both long and short, which gives you the flexibility to be able to make money in any type of market environment. So, as a simple example, let's take global macro or managed futures. Global macro and managed futures both had extraordinary periods in 2022 when all assets went down. Stocks went down, bonds went down. Private credit and private equity didn't mark as much, but they were definitely under pressure. And at the same time, if we look at the last couple of months, those two strategies, global macro and managed futures, have had some of the best performance they've ever had during an environment when assets are going up. And that's a perfect example of the type of sort of all-weather alpha that these strategies can deliver. The challenge for most investors is if you're investing in a single manager in an LP structure, that's the challenge for most advisors. You don't actually see that sort of outcome because of high single manager idiosyncrasy, which creates a lot of volatility around sort of the indexed alpha. And number two is the manager takes all the alpha away in fees. And so if you can diversify the managers and cut the fees, which we do as much as cutting them by to 1/10 of the fees in our 2x products, then you've got a radically different return profile that is one of the most diversifying returns that you can bring to a 60/40 portfolio.
Yeah. And so now, I mean, you've created a stable, you've got 4 ETFs, HFND, HFGM, HFEQ, and HFMF. Sorry, I got to say them all. Can you just walk me through what HFEQ actually does day to day? What's the fund looking at, and how is the portfolio really built?
Yeah, so HFEQ, all those funds are built on the same technology that I described conceptually a few minutes ago. That technology that looks over the shoulder of managers and infers how they're positioned. HFEQ is really focused on equity long short managers. Now, those managers are typically taking positions uh, and exposures, sort of net exposures, in various stock sectors, factors, sizes, geographies, some slices like free cash flow slices and capex and things like that. And so those sorts of managers, when you look at the sort of the wisdom of the crowd, that's how they, there may be some managers that are, you know, 400 of them are short Tesla and 600 of them are long Tesla. But when you net that all out, you actually get pretty good quality alpha, particularly when you're only charging 95 basis points for it at a 2x target return. And so those managers are basically adjusting their equity positions through time in order to, they sort of maintain an equity beta, meaning it's like an active equity strategy with a positive beta to equities, like 0.8 beta to equities, but they're adding alpha on top of it. And it's pretty neat. When I actually started this, I was a little skeptical, honestly, about does it make sense to have a equity long short product, an active equity product. And the amazing thing is, if you'll look at a blog on our website, I actually compare the ability of equity long short managers, what their returns look like relative to the top 100 actively managed equity ETFs in the market on a matched time frame. And what you see is that equity long short managers outperform the vast majority of the top 100 actively managed equity ETFs across the vast majority of different indicators like Sharpe or information ratio or just straight out return over the course of the last on a match time frame basis. It's quite remarkable, and maybe that shouldn't be a surprise. Like hedge fund managers are smarter than active ETF managers. That's all there is to it.
Well, I guess the same question would apply because I want to talk about HFMF as well. So if EQ is your long short, what's the difference to this fund? What's the underlying here?
Yeah, so managed futures, it's a managed futures strategy. And I actually think, fortunately, thanks to the work of Corey and Andrew Beer and a lot of people in the managed futures space, I mean, managed futures like having a renaissance out there. And so most advisors are familiar with it. Managed futures, for those who are not, who are less familiar, is basically trades global assets like stocks and bonds and currencies and commodities and adjust positions based upon recent price trends. And often is referred to as a trend following strategy. So prices go up and you go long, prices go down and you go short. And the reason why that works out over time is because markets have serial correlation, right? So fundamental factors aren't necessarily fully reflected in a price instantaneously. And so if you can get ahead on the price, particularly if you can do it in a way that is quite disciplined, which these systematic approaches do, then you can generate pretty good alpha over time. What we're doing, our sort of, we have a slightly different replication approach than say what the folks at Return Stack are doing or what Andrew Beer's doing over at DBI, but no one would really know the difference from an eye in terms of the difference. And they have great products, and you should absolutely be looking at those as well. But what we're doing is we're targeting a 2x target return. So one of the challenges in the managed future space is that it's a pretty episodic set of returns, particularly ones that are defensive. And so you can have long periods of relatively modest performance, and then some periods of relatively extraordinary performance that are particularly diversifying to a 60-40 portfolio. If it's a big cash line item in your portfolio, as an advisor, you've got to defend the periods where the returns are relatively modest. But if you can get a more cash efficient implementation of it, which is what we're offering, then essentially it becomes a smaller and smaller, less relevant line item for advisors. So you don't have to talk about it. And you get that nice convexity in defensive properties when it's necessary.
I love it. So you're calling this the third generation replication of your model. So what can you just walk me through the journey of that? There had to be a first and a second for you to get to the third. So what are you doing today in your approach that makes it unique and different and iterative over what you've maybe done in the past?
Yeah, I love talking about the history of replication, partially just because like I'm a data science nerd, and so this is what I enjoy, particularly when I go to CFA chapters. This is the fun stuff. The concept of replication actually is 30 years old. It actually started with Sharpe, who looked at a mutual fund, active equity manager mutual funds back in the 90s and said, can I understand which factors or exposures describe their alpha? Andrew Lowe then picked it up in the early 2000s with the basic idea that you could use rolling regression. So look at hedge fund returns and look at, the returns of stocks and bonds and the dollar and gold and things like that, regress the two upon each other. And you could basically infer how managers are positioned, and you can replicate what they're doing, right? You could say, well, look, I basically know how they're generally positioned. I can replicate it. That sort of rolling regression based approach really served as the foundation of how most hedge fund replications were implemented, really from Lowe's period all the way up to relatively recently. And in general, found very poor traction in areas like global macro, where there's a wide set of assets and where, you don't, if let's say if you have a 30 asset portfolio that's plausible at any point in time, you have to have at least 30 months of data in order to do your regression. And even then, you should really have 60 or more than that in order to get an unoptimized regression. And so that doesn't really work because, hedge funds change their positions more than once every 5 years. It did work in the managed future space. And the reason why that is there's high frequency data around performance. And very importantly, the positioning is relatively constrained, meaning like if the yen's been falling, managed futures managers are going to be short the yen. And so you have an ability to constrain that regression in a way that's a little easier than something as open-ended as global macro. 30 positions could be long, could be short, who knows what they're doing. And so that's why I think it really caught on quite favorably, and for good reason. It's done a very good job in the managed futures space to replicate how those managers are positioned. The challenge is in a lot of other places, we needed more powerful statistical techniques than just rolling regressions in order to pick up that tactical alpha. And frankly, we've come a long way. Like as a person who's been a systematic investor from the early 2000s to today, you know, I have gone from running rolling regressions as being novel or at least standard to now machine learning techniques being the cutting edge approach. And so my partner and I, we developed a proprietary machine learning approach, a Bayesian model, which does that probabilistic modeling and inference based upon timely returns. And the great thing about that is it allows us for a lot of these different strategies to understand what portfolio of positions is describing the returns as close to today as we can, in a way that leverages and contextualizes that set of positions in the past, but it doesn't average them in. And so it's a perfect sweet spot of using that past historical information, but getting that tactical alpha positioning that we're inferring. And it's stuff that in reality was not like commercially viable 5 or 10 years ago. With the advent of cheaper and cheaper compute, now becomes something that we can run on an ongoing basis.
Yeah, and I'm gonna ask a dumb question here, Bob, because I know you guys are already, utilizing AI in your process and machine learning, but I mean, the last 2 weeks, I don't wanna age the episode, have been pretty crazy in the world of AI. How are you guys thinking about continuing to iterate? Can this continue to get better?
Yeah, we're always, any manager needs to, any systematic manager in particular needs to be constantly thinking about what are the best techniques, what are the best approaches to, meet their goals. And so, and our goal is to understand how hedge funds are positioned as close to today and as accurately as we possibly can. And so we're constantly working, part of the process is constantly working on, you know, both, I'd say, incremental refinements of how we're approaching it, but then also looking forward to find what is the next technique and the next technique and the next technique, and do they apply? Now, the reality is that if you build something that's robust at the outset, it's actually pretty hard to do something better. I think that's something that a lot of people don't realize. Like when you run a systematic, whether you run a proprietary systematic process or you run what we're doing, which is a replication system, a proprietary replication process, like 95% of your explorations fail in terms of improving the process, and that can be a little bit uh, demoralizing to some. But actually, when I look at that, I say, no, that's actually really good because it means that you haven't over optimized your thing, and so the process that you've used, and so 3 years later you want to totally revamp it. And so we're constantly on that cutting edge, looking at marginal to major improvements, and we'll keep working on it.
Yeah, I love that. I've been preaching that for years is once you find robustness, there isn't much benefit to doing like major overhauls of tweaking. You actually end up losing where you were in the beginning, and then your strategy becomes unrecognizable to the things that you've believed in and have worked. So yeah, I mean, look, as a systematic manager, you got to tweak, but the most important thing is to find robustness, not you know over optimize a model to the point where you like what the returns look like, but they're trash in real life.
Yeah, you could always tell if you've been around the business long enough. You say, "Oh, give me around a sample simulation," and the worst thing you can see actually is something that's too good, right?
Bob, it's funny. I don't even have to ask for that. You just look at the V shape on the fact sheet of, the model performance and then the back test versus the benchmark, and you can get a pretty good idea that it's been optimized, about as optimized as they could have made it.
Exactly, exactly. I think, to be honest, that's one of the challenges in the hedge fund replication space. I think one of the biggest challenges has been a lot of the efforts to bring products to market have been developed by people who are more technologists than they are asset managers. And so, like, you know, in this conversation, like, you've been an asset manager for a while, so have I. Like, robust robustness is the thing that you're thinking about, right? Not perfection. And so, I think that's one of the any of these processes, any of these sort of systematic approaches, again, proprietary or doing the inference that we're doing, there's an art and a science to it. And really, I mean that seriously, because part of what you have to do in the process is to say, how do I create something that will, in the moment, may not look as good as it could, but will in the future look better than how it could look in the moment. And so that sort of training and thinking, that's the sort of stuff that comes from having run money for decades and seen the problems with trying to be overly precise. And it's sort of core at the way in which we have developed our processes. And part of that's because been doing this between the two of us for 50 years.
Yeah. You bring up a good point. I'm going way off the rails. I have questions that I have prepared, but when I talk to you, we think similarly. So I'm going off the rails here a little bit. I do see a lot of academic strategies and coming to market using AI or being active, but you're right. There is this. It's hard to explain the difference, and I haven't thought about it deep enough, but the difference between finding a good strategy or good returns risk returns in academia is very different than actually implementing them in real life. And so I guess I'd ask you to expand on the point you just made. I don't know if you've thought about it at all, but what do you think that difference is from somebody who has run money, understands asset management and deploying strategies versus somebody who is a technologist or an academic that is putting theoretical ideas on paper that look good, but in reality they break when you start to run them in real life.
Yeah, I think a good example is just thinking very simply and from sort of the world that I'm working in these days is thinking about what should your opportunity set be. And so if you think about managed futures, it's like, okay, there's, I don't know, 200 assets you could plausibly trade in one form or another. If you go back and test a whole bunch of different combinations, you will get some combinations that look good and some combinations that look less good, right? And some combinations that literally look terrible, as if managed futures is a totally nonsense strategy. And the reality is the outcome of that is it's just noise. It's just selection noise. And so faced with that circumstance, you basically have a range of different options to approach it. One is to try and optimize to the perfect combination, which will, for instance, here's a very simple example, which would have excluded silver from trading in your portfolio. Actually, Corey wrote about this recently, which I thought was pretty funny. You would have never included silver in your managed futures universe because it was kind of mediocre for, I don't know, 30 years, something like that. And obviously it's gone up a lot recently. Other approach is to basically say, look, I've tested a bunch of combinations. It basically shows that it's pretty good across a wide range of different plausible combinations. I'm not going to get too worried about that. And so what I'm going to do is I'm just going to write down the top 20 assets that matter. Let's just say by magnitude or or, I'm going to have, 5 equities, 5 currencies, 5 fixed income, 5 commodities, or something like that. You just kind of like in a blank sheet of paper, write the things down. And then you say, hey, look, that's what we're going to use. And of course you can back test that and make sure it's not something that's totally insane. But that is, that's a very robust strategy because you're not reliant, your opportunity set isn't really reliant on any particular empirical evidence. It's relied upon intuitive evidence, understanding that these are the major exposures that the managers are taking, and knowing that over time that'll basically get you what you need. So that's actually how we approach all of our opportunities, whether it's managed futures or equity long short or global macro. I like to describe it as we are comprehensive in our approach, but parsimonious. And that is a very, no academic would solve a problem as comprehensive and parsimonious because because it fails because it inevitably will it will look worse relative to all the traditional academic outputs, even though it's a much better way to manage money.
Couldn't agree more. Let me get back on the rails here. You've argued industry is moving away from 60-40 to, your model 50-30-20. I think the market forgot what happened in 2022 rather quickly because stocks keep ripping and advisors really haven't been punished for that 60-40 too badly. What is the pitch to those advisors now? Because I argue the time to allocate more heavily to alternatives is when you don't think you need them. And so what's kind of your argument for advisors looking at a bigger chunk of their allocation to be in alternatives rather than thinking fixed income is the non-correlated bucket and doing it just in two buckets instead of these three?
Yeah, well, I think for most advisors, part of the conversation has to be how do you add, for instance, diversification potential, let's say, to a portfolio without necessarily creating too much tracking error on your existing 60-40? Because there's nothing worse than like trading in diversification for large tracking error and therefore, having to explain it to clients why you're underperforming this or that. And so part of our idea or our focus really is around looking for strategies that do well across the market cycle so that they can do well in positive environments and negative environments. So they can keep up in an environment of strong performance, but they also have the ability to create diversification in downside markets. And obviously no strategy is perfect. That doesn't mean they will always do that. But what it does mean is that having that potential is important. So it's why for us, a real focus on these 2x target strategies is really important because the the biggest indictment of the sort of alts and particularly the liquid alt space over the last couple decades has been like, you don't get a lot of bang for your buck. And that is absolutely right. The volatility is too low and the fees are too high. And so, but it doesn't have to be that way. There's no reason why you have to take, you know, the BlackRock strategy that has, de minimis returns over time at low volatility. You don't have to do that, right? You could simply target a higher return, something akin to something like equity index volatility, which is, we all experience equity index volatility. That is the basis for basically everyone's portfolio. There's no reason why you can't run these strategies at that level and cut the fees. And when you do that, you start to see things that create high diversification potential and at the same time are not sort of dragging on that long-term expected return the way many previous rounds of liquid alts have.
Yeah. So if someone's taking a look at your full suite of product, like I said, you got four. I love the idea of these 2x return replication strategies. I think it's a great idea. But if you're sitting down with an advisor and they're looking at your full suite, how would you look at maybe combining some of these strategies together for the best possible outcome? Are there some you would say, hey, look, this single fund is going to get a lot of what you need, but how would you sit down with an advisor who already has a diversified portfolio to get your funds in there in the way that would give them the best efficiency?
Yeah, I think for most advisors, so they're running they're trying to target like 10% returns or in that order of magnitude. And so most are looking at our 2x products because they are cash efficient across their portfolio construction. And in that space, there's basically the equity long short product, which you can kind of think about as an active equity replacement. And so if you're looking at active equity, take a look at what we're doing. It's a different approach than many existing active equity ETFs. And then you have managed futures, which really is that defensive, that high convexity defensive property portfolio, which is really, it's there in the times when things are challenging. Doesn't mean they can't make money in other environments, but that's predominantly a defensive portfolio. You might think about it with other defensive strategies like say a chaos ETF or something like that, which is protecting in downside environments. And then really for us, what we found is that the global macro strategy, which in many ways I describe as sort of an all-weather alpha, meaning it can go anywhere, like globally, long or short, and can go across different markets. And therefore it can generate alpha, positive, strong alpha in a wide range of different market environments. And the reality is when you think about sort of the balancing of I want diversification, I don't want necessarily too much tracking area, I want higher potential return in a wide range of different market environments and a little flavor of defensiveness, that's really where global macro sits. And so I mean the reality is most people for their first moving into our products are looking at the global macro strategy. I mean, it's why we've been able to get 100 million in it, bit by bit over the course of the last 9 months because they see the real potential of it. It also doesn't hurt in terms of how it's delivered on its mandate since we started.
You walked me right into my next question, Bob. I was gonna ask, you've crossed some 3-year marks on HFND. You've started to raise assets. I think you and I run pretty small boutique shops in a world where we've got to compete with people with marketing budgets. So talk to me about the hardest part of trying to get these things off the ground and how you've, had some success here or in the early stages.
Yeah, I think it's hard in the what is it, the ETF Terradome here to differentiate yourself. I think part of the way that you differentiate yourself is you actually have to have something different to offer. If you're another equity value manager or whatever, like who cares? Like you're indistinguishable from 100 others. And so I think part of the fun in reality and part of the interesting thing is like you have to start to look at the path for boutique ETF issuers is to bring unique differentiated products to the market, and particularly those that ideally have some sort of investment management moat, meaning like, is not going to be easily replaced by BlackRock, Vanguard, or whatever, because that would put a real cap on your business. And so that's so you start with that. You have something that's compelling along that dimension, and then the reality is, from our perspective, you can't, we can't beat State Street on number of reps in the field, dollar value of sponsorship at exchange,
Yeah,
number of billboards.
where's your two-story
I know, right?
sponsorship at
Literally
exchange?
the
Yeah.
biggest at Future Proof, right? We cannot win on that dimension. And so we are guerrilla marketers. And so the way that we do it, the neat thing is like 20 years ago, it would be basically impossible.
Yeah.
But what we can do today is we basically know we have the contact information for every single advisor in the country. We have data, live data about what basically every RIA holds in their portfolios. And as a result, what we can do is we can channel information, content, understanding, education to those folks who have the highest probability of being interested in our products. We don't want to spam everyone in the world. We want to find people who are excited about what we're doing or could be excited, might be an investor in a competitive product or a related product, right? Or might be just someone who's shown interest in looking at cutting edge ETFs, ones that don't have 3-year track records or are from the indies. That's all information that we can see live, and we go through a process of leveraging that to do it. And I like to say we have like a $0 marketing budget. I mean, obviously we have some employees, but we're not spending money beyond leveraging that content. Now, look, that works for a period of time, and then there'll be a day when it will make sense to scale up our sales and distribution. But the biggest thing, and I guess this is a little bit for like the industry people, the startup ETF industry people, the biggest risk you have as a startup ETF, if you have a product that's differentiated and an investment moat, is that you blow yourself up spending too much money on sales and distribution. That literally, that's what it is. That you will die. And we have seen one company after another blow through tens of millions of dollars without much to show for it, doing it right off the bat. And so the key thing is stay small, stay focused. And if you do that and you have a good product and you stick around long enough, you can really differentiate. And it doesn't take much. Once the ball gets rolling, every day those creates come in and you're like, here we go.
Yeah. Yeah, it's funny. I think it's you said a lot of things that I can relate to there. And getting those create emails, even if it's 500 grand, 600 grand here, you're like, yeah, it's a win. But I always joke with people, I'm in a constant knife fight with RIAs that are under $250 million for attention. I mean, it's a much different way of, as you put it, guerrilla marketing and trying to get your name as a boutique issuer out there without a big marketing budget. But I guess that's what makes it fun. And it's been fun, watching your success. And so, where can people learn more about Unlimited? Where can people get information on all your funds? And I know you're pretty active on social, which is always a good follow. So why don't you give people a little bit of information about that as well?
Yeah, yeah, for sure. Anyone who's interested in our products, you can go to unlimitedetfs.com, where you've got all the sort of standard information, or just reach out and say hello. We're we're not some big shop that you can't get a conversation with the people who are running the money. And if you're interested in sort of my broader macro thoughts and content, I run a Substack called Non-Consensus, which you can find by Googling it, or check me out on all the socials at Bobby Unlimited, where I'm pretty active. So definitely say hello.
Well, Bob, thanks for spending some time with me today. I appreciate you doing this.
Thank you so much for having me.